Good morning and welcome to the Coinbase Institutional Markets Call, and happy 3K in Ethereum. We got to that in Bitcoin last week, and it's nice to set in Ethereum. Now, admittedly, we are trading a little bit lower than that, but we did touch 3K. So definitely going to take that one for now. And we've certainly seen some strength in the ETH BTC pair too. We've got Greg out today, so wishing him a relaxing vacation. Hope he's able to recuperate. I think he's probably doing some skiing. So today we have some awesome updates, and we're pretty heavy on some new launches, which we're going to run through with George and Sid and David. And then we've had some news out, which is really affecting some SAM coins, which we're going to dig into a little bit more. On the agenda today, George is going to run through a market update, including an update on ETF flows, both year to date and last week. And we're then going to pass on to David to run through some macro. It's a super busy week. We have Fed minutes, initial jobless claims. We're also going to hear from a number of Fed members, so David's going to run us through what to look out for there. David, while we're talking of you, SAM coins, I bet you weren't expecting SAM coins to come back, were you?
Well, I think they were overdue for a rebrand, so I'm kind of glad that the Sam we're talking about is Sam Altman with regards to the launch of Sora on OpenAI and kind of the resurgence we're seeing on WorldCoin.
Yeah, it's amazing. I mean, for those that haven't checked out Sora, it is incredible. Obviously, it's a closed beta right now, but it's pretty amazing what is coming. Amazing and scary all in one breath. But we'll cover that more a little later. Sid's also going to run us through liquid staking, which is shaping up to be a highly important part of this cycle, but also a part where some people are worried a little bit about potential additional leverages coming into the space. So we're going to run through some of the potential risks there. We're also going to have a bit of fun looking at pudgy penguins versus Bored Ape yacht clubs. So yeah, a lot to discuss. We're going to get right into it. But before we do, if you're watching on video, don't forget to scan the QR code to access David and the team's fantastic research. And no matter what platform you're on, don't forget to click like and subscribe so that you get all of the podcasts delivered directly to you as they come out. But without further ado, George, let's kick off with a market update. Over to you.
Awesome. Thanks, Ben. Yeah, as you say, definitely been a pretty exciting week. Price action-wise overall, I think if you look at it on a weekly basis, pretty positive. Total market cap is now just under $2 trillion. And we are actually, if you look at the fear and greed index in crypto, solidly in greed territory. I know it's a bit of a meme, but doesn't harm, I guess, keeping an eye on that. But, having said that, subjectively, BTC at 52K or 51K, to me, kind of almost feels like 30K, maybe 35K in the last cycle for some reason. And, if you look at market depth or liquidity, that's been improving. Market depth is up 23% in Bitcoin since the end of November and 30% over the last year. So that's pretty good. And Bitcoin itself actually also reclaimed the $1 trillion market cap crown and is looking pretty solid technically, I would say. And depending on how you look at gold, one estimate is that there's around $7 to $8 trillion of gold above ground, including things like jewelry. So pretty solid for Bitcoin, I would say. ETFs also looking healthy. As of late last week, we stand at $5.2 billion total inflows across all products in Bitcoin year to date, and $2.5 billion inflows last week. So that was a record, super strong week there. If you look at Grayscale, the other side on the outflows, that's accelerated just slightly towards the end of last week. So we were around Thursday, Friday, we were around $150 million daily outflows or so, but it's still, significantly less than in the beginning when we had a run rate of around $550 million a day or so. And the other thing that's worth keeping an eye on in the majors that stuck out obviously over the last week is ETH, which is finally catching a bit of a bid after a long period of underperformance. So that's been interesting to see as well.
Interesting. Thanks, George. So just going to go back to the fear and greed index. I mean, you say it's a bit of a meme, but I do think like a lot of the data points that go into that are actually kind of insightful because it takes a broad spectrum across different, whether it's like volumes or what's happening on social media. And there are various things that I think probably are worth reading into a little bit. I guess how cynical should we be about that? And how good has that been in the past of predicting whether or not we do see a bit of a pullback or whether or not the kind of the move continues?
I mean, I think if when we've seen like super extreme moves, like going close towards 100, like max greed, or like let's say during the bear market, it's been relatively accurate, I guess. Calling that, I think that was like the around 10 or so where the readings were seeing there, and that kind of like coincided with peak fear and minimal price levels. But I agree, as you say, like it's a relatively broad range of data, like including things like Google Trends data, or I think they're also using the BTC market dominance. So obviously higher dominance, meaning there's more fear with a flight to safety within crypto. So there's a wide range of factors, I guess, that are worth looking at, and are all sort of combined in that one metric. And then, but yeah, I guess if you look at that and then look at other things like what's leverage doing in the system, where funding rates, open interest, and so on, I think it's as one tool in your toolkit combining with many others, it can be quite useful.
Yeah, 100%. I kind of look at it a bit like an RSI for technical analysis. It's like it's one thing you add that is potentially helpful. Just really looking into it, it breaks down 15% social media, 10% trends, so like Google Trends, for example. So if you've got like, and then 15% surveys, if you've got like 40% coming from what's coming from either like surveys or social media or Google Trend searches, stuff like that, I feel like for still a market which is somewhat retail driven in many ways, I think that's kind of important. And then another 50% is market momentum, volume, and volatility as well. So it's kind of a good cross section across maybe some of the more traditional metrics like volatility, and then some of the less traditional like social media and Google Trends and things like that. But yeah, certainly one to watch. And ETH at 3K, okay, I'm being a bit positive, a little bit below 3K now. But how does that kind of look in terms of what's the setup like? And has anything changed over the last week or 2 weeks? We've obviously been talking about ETH having a bit of a resurgence. And David, would love to bring you in to discuss your report in a second as well. But George, from your perspective, from a trading perspective, has anything changed in the last week?
Yeah, I mean, I don't think personally like that there's been any news in particular that have resulted. But I think there's a number of probably more like fundamental structural factors that have been known and are known like for a pretty long time, right? I mean, from even with the halving and BTC, the supply side in ETH, if you look at ultrasound money, I think does look definitely more attractive, especially if DeFi activity picks up as well. And in general, I mean, it was just very, let's say, underappreciated over the last weeks and months. It's been underperforming a lot versus BTC and versus other coins, even like ETH Beta, like OP or ARP, for instance. But in the end, I think like if you look at the big picture, right, it's going to be as institutions enter the space, right, and let's say a lot of them might have missed out on Bitcoin. It's only going to be natural that they're going to try what's the next best thing is probably going to be ETH. And in the end, like as rates come lower, probably towards the end of this year and then into next year, that should make ETH even more attractive as the probably the largest legitimate yielding asset in the space. And also there was some talk on Twitter actually of some address associated to a certain high profile crypto figure buying $150 million of ETH actually over the last couple of days, I think. So that's been interesting to see.
Interesting. And David, I know you had an awesome report out last week covering it. Do you mind kind of just running through that a little bit for us?
Yeah, I think George framed it very well. But our thesis is that ETH is really the next big trade in crypto. And, part of that has to do with what George is referring to as far as people kind of overlooking ETH. It's certainly underperformed a lot of its peers since the beginning of fourth quarter of last year. That includes like Bitcoin, Sol, for example. So I think that probably contributes a big part of it. But also, I think that we're starting to see a resurgence in terms of DeFi activity. I think that's going to be a big theme within the first half of this year, for example, just because some of the market neutral strategies that were available to a lot of people have, probably aren't going to pay as well due to the spot Bitcoin ETF. What I mean is you have things like the CME Bitcoin futures basis kind of trade, for example, which I think is still going to be there. But simply put, it's just not going to pay as well as it did previously, given the capital requirements are involved in that trade. I think for a lot of crypto natives, they're going to look elsewhere, and that includes DeFi, for example, because you can get upwards of like 10% on Aave, on certain networks, for example, if you just put in for stablecoins. So I think that if you're going to see DeFi activity really start to pick up, that's going to help ETH and Ethereum, just because still a lot of DeFi activity takes place on Ethereum today. But I think the point about the ETFs shouldn't be lost. I think right now, a lot of people are pricing in like 50% odds, if not lower, for a spot ETH ETF to be approved by May 23rd, for example. I think that the odds are actually a lot higher than that. I would put that somewhere above like 60%, maybe even 70%, in fact. And that has a lot to do with the nuances that I think are involved here. And maybe we don't have enough time to kind of get into all of them. But I think that that's not really being priced into the market at the moment. So I think that there are a lot of strong catalysts for that. And then you also have on the fundamental side, things like, Eigenlayer starting to come online, for example. Like we're going to see that some of the first actively validated services are going to be available in the first half of this year. So I think that will also be a big catalyst for people looking for yield and looking, as George kind of said, towards like, tokens that actually pay off a yield and are part of the, I would say, framework of what people are, the benchmark really of what people look for when they're investing in crypto if you're an institutional investor. And really, that still kind of puts you in a very small circle, including Bitcoin and ETH.
Yeah, 100%. I guess also, like Eigenlayer you mentioned there, like a large amount of ETH is staked in Eigenlayer, either as native ETH or as in staked ETH. And just to George's earlier point, the supply that's available is just going lower and lower as people are utilizing their ETH for other things. And as we've discussed multiple times before, I think people that own ETH right now have held it through the highs, held it through the lows, and they're kind of, it becomes more of a position in life versus a trading position, I think, in some ways. But yeah, we'll come back to that a little bit more. But George, what else is going on from an update perspective?
Yeah, so on the altcoin side, obviously a lot of narratives flying around. I think the one thing that has been sticking out to me on the institutional desk here is that there's a lot of institutional clients, both coming from traditional financial firms as well as crypto natives, that are quite interested in like a lot of the longer tail projects, narratives, and it's the usual suspects, right? Like DeepIn or DeSci, Web3 gaming, tokens making a little bit of a comeback. AI tokens obviously have been doing really well. So after OpenAI launched, Sora WorldCoin obviously rallied almost 150% of the last week. On the DeepIn side, you had Filecoin, which is also catching a bit again. And it's actually number 10 in terms of open interest out of all coins now, just over $200 million open interest. And another topic that has been coming up as well in conversations is EVM parallelization. Obviously, not that many tokens in that space. And I guess Say is probably the most prominent one there. So that one's been up 25% roughly over the last 7 days.
So let's jump back to Sam coins, to WorldCoin, to Sora. Sid, would love to bring you in here as well. Can you kind of just give us a little overview, like on its like valuation, some of the like the fun facts around WorldCoin specifically, and maybe like how does the value from Sora feed back into WorldCoin?
Yeah, it's a bit enormous in terms of how crazy the ecosystem has kind of become over the past few weeks. Yesterday, WorldCoin hit $75 billion in fully diluted market cap. Today it's albeit a little bit down, close in the 60 billions, but still a substantial increase from its initial launch price and also its airdrop price. What's interesting to note here is historically last year when they were onboarding folks to the WorldCoin network, they specifically went to different countries to try to onboard folks on the ground to scan their eyeballs on the WorldCoin orb, and then rewarded them with world tokens, WLD tokens on the app. And I saw a few folks from the Indian crypto community post that several folks have gotten, several months to a year's worth of salary in airdrops just from scanning their eyeballs. They'd posted screenshots of this. In rupee terms, it was obviously a substantial amount. And all a result of this tremendous inflow into WorldCoin, and largely because of the mimetic value of it being a SAM coin. the same developer behind OpenAI and Sora, obviously with driving a lot of narratives in the ecosystem. There isn't exactly clear relationship per se between the two, but just the fact that it's related, I think, merits a kind of increase in attention to this coin.
I guess it's kind of interesting looking at that from a distribution perspective. So anyone could go and scan their rival. A lot of people chose not to, but for those that did, they all potentially get. I think it was around like $6,000 or $7,000. I think maybe that was about that. Obviously, the price is moving out all over the place, but for certain parts of the world, as you said, that's a meaningful amount. I guess the one thing that disappoints me a little bit is that there's no clear distribution of value from Sora to WorldCoin. Like, there's no connection there, and we've seen this countless times in the past, but I feel like so many of these price moves, for them to be truly sustainable, you want to see something where you can do a DCF, or like you can actually like link the value to the value that's been created here to the value that's being created here. But I don't know. We'll see. George, curious, do you have any kind of thoughts on that? Did you scan your eyeball?
No, I did not. I guess I was one of those where I was a little bit skeptical. I guess at that time there was a lot of skepticism about it's information security and all of that, right? Yeah, I agree. I mean, it's pretty nuts to see the price performance there. But again, like, it probably fits into that narrative, right? We had others like Fetch AI doing really well, right? There's a lot of other AI tokens that have done really, really well over the last couple of weeks.
Okay, here's the next question. For 7K, would you scan your eyeball?
I'd probably consider it, yes.
Okay, there we go. So George's price is 7K to sign away his data integrity. That's good. That's good to know. Very, very cool. Awesome. Another area I would love to chat through while we've got you, Sid, is liquid restaking. I think David mentioned it earlier on. Can you just start and just give us like a brief overview of what liquid restaking is, maybe some of the companies involved? Because it feels like something that's come up a lot in conversations. George has mentioned it a couple of times in previous calls, and it feels like it's something that's going to be very relevant this year as we go on. So it's really helpful for everyone to have a good foundation on it.
Yeah, absolutely. So, I mean, liquid restaking is basically this concept that's arisen out of the core staking that's happening primarily currently on Ethereum, but it applies to any proof of stake network, really, where there's a native staking yield that's given out by the protocol. In Ethereum's case, it's close to 3% at the moment. And then the kind of drawback with native staking is you kind of have to lock your assets, you stake your assets, and they're not liquid. So the innovation here with liquid restaking is you stake your assets and you delegate them to a service provider who then stakes them amongst several validators, and then they give you back a receipt token to say that you have staked X amount of assets, and that receipt token is liquid, and it can be used to lever up on staking yields, or gain exposure to DeFi, or in the case of what's happening now, this kind of rehypothecation of staked ETH for different purposes. Most notably in the ETH ecosystem into Eigenlayer, which is a large restaking protocol which aims to use ETH that's been staked to also validate other use cases. So there's this whole rehypothecation of capital that's happening in this ecosystem, and it poses some open questions and risks, of course.
Interesting. David, we'd love to bring you in here. We've certainly discussed Eigenlayer and some of the risks in the past. Just to make sure we're balanced here, like, what are some of the things that we should be looking out for, or some of the reasons maybe some investors are concerned about Eigenlayer?
Yeah, I think on the positive side, obviously the increase in TVL has been massive, right? We've seen this actually go up to around like $4.3 billion year to date since you saw, Eigenlayer removing some of those deposit caps. So obviously a lot of interest on this side. And I think from a performance perspective, pretty good for ETH, because you see additional ETH kind of get locked up. In fact, I think that's one of the reasons we've seen like validator entry queues, for example, not really emptying out since the end of January. So I think from that perspective, it kind of feeds into what I was talking about earlier. I think that this is going to support that DeFi renaissance I'm talking about, because real yields are just going to become a lot more attractive, and allowing this rehypothecation of staked ETH. I mean, obviously, very attractive from a validator perspective, but I think that the risks on this side, as you kind of mentioned, aren't fully well understood. Like, I think people understand, yeah, there's slashing risk, but the slashing risk is not immaterial. Like, I think that right now, when a validator misbehaves or if they go offline, the risk to slashing, it's there, but it's still fairly de minimis at this point. But if, for example, like, there's something about like one of the validator actually restakes and actually needs to support an ABS, if there is something like problematic about how they're doing that, for example, I mean, the risk of the slashing is actually much greater. So I think that's one thing that you need to be aware of. The other thing is there's a potential for centralization risk as well, because, there might be, like, I think people fully get that, like, when you're staking towards these actively validated services, they pay differently. Like, you're restaking towards a few different protocols, and like you may get like an attractive yield here, but a less attractive yield there. So there's a real potential for a large portion of the ETH to be actually restaked only on a few of those actively validated services, which would then create a bit of a centralization risk around like those ABSs gaining a lot of power and influence across the network. We don't know how that would play out yet, but that's something to think about. And then just kind of like the yield risk itself, the rewards from restaking, they depend on that performance and the popularity of those actively validated services. So if those services aren't attractive enough to get enough users, or they themselves face technical issues, I think that, the yield that you might be expecting from that could then drop. So, these are things that I would just be aware of when you're considering like Eigenlayer. Like, I think it's overall like a very attractive prospect. And, we've been talking about this all year. It's just, you need to kind of keep in mind, like, there's a balance here.
Very cool. Sid, we'd love to hear your thoughts. I know you've been playing around with Eigenlayer firsthand. Like, do you think about it in a similar way?
Yeah, I think so. I think there's two levels of structural risk. One is the Eigenlayer application itself, the staking contract, whether there's an issue there, and then a lot of the different flavors of restaking tokens that they accept. They each come with their own idiosyncratic kind of risks, right? Where you stake to a provider and then they allocate for native yield, and then you then get their receipt token, and then you're taking on the provider's risk as well as Eigenlayer's risk with this kind of rehypothecation. So I think there's two elements there, and then one other big call out I would make is additionally, there's a very popular trade now, especially on decentralized lending markets, which is using staked ETH to have a levered play where you deposit staked ETH, you borrow USDC, or you borrow ETH, and then you stake it again, and then you deposit it back, and you keep looping that back for a kind of hyper staked ETH position, ETH long position, where you get the benefit of ETH yields compounded and also a long ETH, right? And so it's a pretty precarious trade because you're kind of putting that risk on the staking provider, of course, and then loading it up even more. So combined with Eigenlayer and then these kind of levered ETH positions on chain, two big kind of structural risks to be aware of, but also obviously benefits to be had from participating.
If people can loop, people will loop. It feels like interesting. Okay, one to keep an eye on. Is there any dashboards that you guys are looking at to see how this is going? Obviously, just Eigenlayer, their website, but anywhere else where you can potentially plot, I guess, the amount of people that are depositing staked ETH, borrowing ETH, and then putting that into Eigenlayer, or is that a little bit hard to tease out?
Not any clear dashboard that I've seen do it well in terms of the flow, but an easy one to track is obviously DeFi Llama, great source. There's a staked ETH kind of a page there where you can see the increase in Lido staked ETH and then the corresponding increase in Eigenlayer TVL as well, and kind of match the two together.
Yeah, I think there are some good Dune dashboards as well, which kind of show you how much in total AUM is kind of being locked up in Eigenlayer, as well as some of the amounts that you're seeing on the liquid restaking token front.
Perfect. Thanks, guys. One to keep an eye on, and obviously an incredible project that we're all rooting for, but just wanted to kind of think through some of the risks and talk through how people are playing with it at the moment. So the next thing I would love to chat to you, and it's great we've got you both on, Sid and David, is Starknet. Now, this is a super high-profile project which has been going, I think, since 2018, maybe even 2017. And it's kind of coming to a point where it is listed on exchanges and their tokens are available. So Sid, perhaps you could kind of start with just an overview of what StockNet is and then maybe run through some of the dynamics we've seen in the last week.
Yeah, absolutely. So StockNet is basically a zero knowledge roll up on Ethereum, which is kind of a layer 2 scaling solution, similar to the likes of ZK Sync and others. But the key difference is it uses fundamentally different proving technology called Starks, which is the result of a research initiative by the StockNet founders. And recently, last week, they announced the launch of their token and to be distributed via airdrop primarily. 7% of the token supply was distributed via airdrop, and it caused a little bit of controversy in the ecosystem where part of the airdrop criterion was early contributors to Ethereum projects and ecosystem projects, and this was measured via GitHub commits. So there were several cases folks were posting on Twitter and other media channels where they had done significant on-chain activity on StockNet but hadn't gotten the reward they thought they would receive, compared to folks who had made, say, one commit on GitHub, getting substantially more tokens. But yeah, airdrop aside, the token is scheduled to start trading live on exchanges today, on several exchanges, and it already has a kind of going valuation at around $21 billion in FDV right now.
Wow, so that's, I think it's trading somewhere north of $2 at the moment, and I'm curious, Sid, like with some of those dynamics, as people see that trading wasn't how they rewarded people with the airdrop, like what is that? Has that had any secondary effects within the ecosystem?
Yeah, absolutely. So it's actually had quite a few ripple effects. There's been this huge trend on Twitter, especially of airdrop farming threads, which have gotten a lot of traction over the past year, and it's become a kind of systematic way to onboard people to crypto. A lot of the recommendations is if you're starting out in crypto, a good way to get initial capital is to just simply engage with protocols and get rewarded with an airdrop. And so vast communities of airdrop farming influencers started essentially advertising for folks to go and commit to GitHub repositories as a way to qualify for potential airdrops. And so this is most clearly reflected in the scroll. It's also a ZK, layer 2 solution that they had a public GitHub where they were giving out POAPs or kind of NFTs for contributors to their GitHub, and folks thought this was a criteria for an airdrop. And almost overnight after the Stark airdrop, there were over 1,000 new pull requests and issues raised on the Scroll GitHub, which is problematic to say the least, because the actual developers who are building the Scroll protocol open source will have to kind of sift through these requests to figure out what's noise from what's actually of value, right? So it's interesting side effects in terms of the follow on from this.
Yeah, I think that byproduct should not be underestimated too, because I mean it seems kind of funny from the outsider point of view, but it's really not. People are hunting them for like typo fixes so they can be included in these airdrop lists, and it's kind of just like, oh my god, it's kind of like nuts a little bit to kind of think about that. But the problem is that this really could inflate the number of commits and contributors and trying to actually measure out developers. So it really distorts a lot of those metrics.
So for someone that's not technical, that doesn't engage with GitHub frequently, can one of you explain exactly what the process looks like to submit a pull request on GitHub?
Yeah, it's pretty simple, to be honest. You just create an account on GitHub with email and password, and then you go to these open source repository. It's just a URL which shows the code of a project and its developers that are committing to it. And then you simply suggest a change. Like David was mentioning, a lot of these changes have simply been to add Scroll the project to another repository's token list or a list of projects, or it's a typo, for example, a small typo, or just a comment. Any kind of arbitrary change, you can suggest that, and you raise that as an issue on the GitHub, and that gets surfaced as an issue. And the developers would have the choice to basically address that issue and resolve it or reject it. And that's kind of the end-to-end process.
Kind of reminds me of like Steve Ballmer back in the day when he was like developers. Like it feels like StockNet or Starkware are doing the same thing. That's kind of where they want to prioritize. Interesting. Well, certainly one to watch. And Sid, I'm sure you've been playing around with that. What is live on StarkNet that you can play with now? Like, where are they seeing the most traction?
What was interesting with StarkNet is they actually partnered very closely with a wallet called Argent, and Argent was a primarily mobile wallet, and they had a lot of quests in 2023 for folks to interact with StarkNet and get involved with the ecosystem, and those quests were integrated with Argent, so people had to download this mobile app. Mobile wallet called Argent, and then interact with StarkNet locally. And most of these quests involve games, and that's kind of the leading ecosystem plays at the moment. Games. One extreme, a good kind of use case, adapt use case that's gained a lot of traction is Sorare. So Sorare is a sports trading card marketplace that has a kind of back-end network that's running on Starkware. So that's interesting to see. And then other sorts of small games have gained a little bit of traction, nothing quite mainstream yet, but I think Sorare is a good example.
Interesting. Well, good to see some of those games picking up traction and users. We definitely want to see that across the ecosystem. Cool. I think, Dave, while we got you here, maybe we go into some macro. There's a few things happening this week.
Yeah, I would say a lot of the news is concentrated on Thursday, actually. That's when we're going to get initial jobless claims in the U.S. We've also got no less than 4 Fed governors speaking. So that's going to be Jefferson, Cook, Kashkari, and Waller. This is probably going to be pretty important, especially, I would say, Philip Jefferson. He's the vice chair, and he's been more of a centrist on the board. So I think that his voice tends to be a little bit closer to Powell's than most. Cook's also centrist, and Kashkari and Waller are more of the hawks. Although to some extent they've been less extreme than they were previously. But Chris Waller is a pretty big voice on the board. So it's going to be really important to hear what he has to say. He was actually the one who initially made the markets think that a March cut was in the cards before then backtracking. And now, of course, we now know that March is very unlikely. And if possible, the first cut will be in May. Some people thinking that it's going to be pushed back to June. But other than that, we've also got the Fed minutes tomorrow. I think some people are looking at it. This is Wednesday, of course. Some people are looking at this and they're going to parse the comments that are in there to see what the Fed is saying about inflation. I honestly don't think that can tell you very much because a lot of those comments were based on December numbers. And then we got some disappointing January inflation data. So that came out about a week ago. But that is also not going to be easy to kind of guide us because those numbers in January were contaminated by bad weather, seasonal effects. So I think that really that puts Thursday as probably the biggest on the board to look at.
Perfect. And then moving into next week, David, anything else we should be keeping an eye on or anything else we should be concerned about?
The macro is kind of a bit of a hazy kind of place again. And in part, that's because we're moving in very different directions between what's happening in Asia and what's happening in the US and Western Europe. Obviously, I think that, we are now in the post kind of Lunar New Year period for China and the China data itself. We saw that a lot of that was kind of propped up by, officials who are, of course, going into it, trying to kind of keep markets operating fairly smoothly. But in the post period, they've kind of let that go somewhat. But, I've said before that some of what's going on in Asia are going to have wider impacts across the world. And I think that we are going to continue seeing that there's going to be this deflationary effect out of China that's going to have pass through into the rest of the world. So that for me means that I'm still very much committed to this idea that we're going to get disinflation in the US at least. And that means that the Fed will continue to be on track to cut rates. And that is going to be hugely important because that timing is going to coincide with a lot of things. On Ethereum, for example, we're probably going to see that the potential for spot ETH ETF could be approved at the same time that the Fed starts cutting rates. So I think things like that are going to be hugely important. The halving on Bitcoin is another one. So I think that we need to understand that a lot of these idiosyncratic quote unquote themes that we get in crypto don't operate in a vacuum. And the context is going to matter. And a big part of that is what the Fed's going to do about the rate cuts and about what it's going to do with the balance sheet.
Got it. That makes a ton of sense. And David, maybe just kind of at a high level, I don't want to give too much of your note away because I mean, you gave us a great bit earlier on, but why is it you think the market is being too bearish on the ETH ETF approval this year, just at a high level?
I mean, the top line, it really has to do with the regulatory situation. And, there's been a concern in the past that the SEC views ETH as a potential security. And I think that what people are missing about that is, a lot of what we saw materialize in the approval for the spot Bitcoin ETFs is that they kind of dropped some of the previous notions they had surrounding market manipulation, surveillance sharing agreements in favor of kind of some of the emphasis that the courts put on it, which is the correlations between futures and spot markets. And here, what is important to mention is that the CME ETH futures was actually originally approved as a standard futures, not a securities futures. That's important to me because what it means is that if the SEC were to try to reject a spot ETH ETF on the grounds that they do not believe that the ETH actually should be seen as a non-security, I'm just going to use that as a term, even though that's not the right term, because I want to avoid using the word commodity outright. But if they do that, the risk that I see is that they'd be picking a fight with the CFTC, and there would be this interagency dispute, which I don't think that they necessarily want to do. Now, there might be other questions about, well, how big is the CME ETH futures market compared to CME Bitcoin futures? Because it's really only like 15% of the amount of the open interest traded on Bitcoin futures, for example. So does that factor in? I really don't think it does as much. I really think it's really about the correlation, which between CME ETH futures and and ETH spot is still very, very high.
Interesting. Well, thank you, David. Thanks for breaking it down, and we'll add your details for your note in the show notes, so folks can just click on that and check it out. Cool. And wrapping up, Sid, Pudgy Penguins, talk to us. What's going on?
Yeah, Pudgy Penguins recently crossed the Bored Ape Yacht Club in floor price briefly for a bit. It's back below now, but a lot of interesting takeaways here. One is obviously Pudgy Penguins, the community has been very strong, and part of the reason is the Penguins community as a whole has been getting rewarded with airdrops from other projects over the course of the past few weeks and months. And as a result, it has kind of paid to hold a Pudgy Penguin. It's been a signaler of sorts, similar to Celestia holding TIA. TIA got a bunch of different airdrops just for staking TIA. So in a similar vein, on the NFT front, it's been a lot of positive momentum. And yeah, for folks viewing this on video, great screenshot here of a borrower taking out a loan of $150,000 of USDC with a few Pudgy Penguins as collateral. Permissionless protocols that allow you to do that is great. And with these kinds of floor prices, lots of interesting financial products can be utilized.
So I love part of this in that you can leverage your digital assets and borrow against it in a permissionless way. I think that's incredible. 32% APR. I mean, that's on the higher side, but I guess it is Pudgy Penguin. I guess one thing it's always hard to get away from that this is a JPEG, but it is, it's a valuable, good-looking JPEG. So each to their own. George, would love to bring you. I know you had some interesting thoughts around other ways to think about these from a trading perspective.
Yeah, as you say, we all definitely like valuable, good-looking JPEGs, don't we? But yeah, I mean, I guess another angle on that one is a lot of folks like RV trades, right? And one thing that has been talked about a little bit on crypto Twitter is just looking at the ratios between mutant apes and bored apes and the floor prices there. So that you got a ratio around 5.5 there, and Pudgy Penguins versus Lil Pudgies. Where you have the ratio around 9.5. So, and the floor price for Lil Pudgies right now is around 2.1-ish in ETH, and that would imply like the same ratio if that was to get there, like around 3.7 ETH. But yeah, not financial advice, but something that has been talked about on crypto Twitter.
Yeah, to add to that a little bit, I think a lot of folks kind of make the blanket assumption that these are just JPEGs, etc. And yes, in a sense they are, but and there's obviously financial infrastructure built around them. But pudgy penguins are in Walmart right now for anyone to buy the actual collectible, the plushie, the cute penguin. And
Really?
it's you can look it up, Walmart pudgy penguins. You know, they're going for $20 a penguin, and it's kind of innocuous because it underlies the underlying collectible brand value. You know, we saw the biggest movie last year was Barbie, and you know, Pokemon is always makes the rounds. So this kind of collectible IP is pretty valuable, and if it stands the test of time, it could become a powerful brand.
All right, I'll get back in my box and go and get a pudgy penguin from Walmart. Very cool, awesome. I think that is a wrap for this week. Thank you, George. Thank you, Sid. Thank you, David. Thank you all for listening in and or viewing on YouTube, and we'll see you next week. Take care.